Hello, everyone, and welcome to our latest episode of Talking Global Infrastructure. I'm your host, Vlad Benn, Policy and Research Manager here at the Global Infrastructure Investor Association. Our focus today will be on data centers, particularly demand, power availability, license, and capital. To help us unpack these four issues, we have two great guests here. Please both introduce yourselves.
Hi, I'm Andrew Jay. I'm with CBRE, and I'm responsible for our Europe, Middle East, and African data center advisory business. So we've got people who advise occupiers on taking down colo. We've got a capital markets group. We've got a group that just do site transaction work for data center development, and we've got a research group. So we cover all of the advisory side.
Andrew Tobin is my name. I'm the head of the EU data centres for Turner Townsend, which is now part of the overall CBRE T&T company. So I'm in charge of delivering the data centres and construction delivery for a lot of our major clients, mainly through PMC model. But yeah, great to be here. Thanks very much.
Now, the investment backdrop is quite clear. Infrastructure fundraising is nearly back to where it was in 2022, albeit a little bit slower. I believe we saw around 134 billion raised this year in H1 alone, infrastructure fundraising. And data centers took about 45% of that, so that's 60 billion. Now, this is a continuation of a trend we saw last year, capital allocators targeting the high returns of the sector. This year, has taken it to a completely different level. At the same time, with a bit of self-promotion, our own Infrastructure Pulse survey, a survey which tracks the investor sentiment across Europe, US, and Australia, filled out by the largest and best infrastructure investors in the land, shows digital infrastructure, particularly data centers, as ranking amongst the most attractive sectors for investors. And this goes back to, I believe, 2020 when we first started doing it. So on the ground as well, development is really ramping up. I think JLL expect it to be a record year for development financing in 2025. And our members, last looking on InfraLogic, closed around 26 billion in data center deals. So capital demand is all there. However, this growth is colliding with some of the constraints. Estimates show that data centers account for around 9% of electricity consumption in the US. Grids, as well as key water hubs, are coming under big strain. So with the cocktail of opportunities, barriers, let's maybe talk about the demand and some of the long-term drivers of the demand. So, Andrew, perhaps I can come to you. Where do you see demand? We've talked about AI as well. Where is that AI demand generally bankable, and what convinces you that it's durable?
I was amazed it took you 60 seconds before you used the AI word in introducing that. But just for a second, if we turn to the non-AI demand drivers, which is all about cloud adoption, and more enterprise organizations are going from on-prem to off-prem, and that generally is a cloud and sometimes a hybrid environment they're building. So the fundamental drivers of data center growth around cloud adoption remain strong. Just look at the earnings calls from the big three or four hyperscalers. So AI, I view then as an additional demand on top, and oh my goodness, it's a huge demand, particularly at the moment. Is it bankable? In my world, it absolutely is. So we've gone through with AI demand a little bit of an evolution where, if you go back 2 years when we started to get into AI, we built a relationship with NVIDIA and went to their GTC event and things. I was literally getting people coming up to me. We had a stand there saying, "Have you got any data center space?" And it was literally one chap. It was a gentleman with his son saying, "Have you got 40 megawatts of data center capacity, please?" And understandably, that just hasn't come to fruition. What we seem to have now is a smaller group of more specialized, we call them now the neo cloud companies. They're providing this GPU as a service type solution. And we're seeing evidence of contract-driven demand from those companies. So we're seeing in the UK, I mean, we just happen to be sat in the UK, but Nebius have announced a neo cloud, a sovereign neo cloud very recently. They're launching it at the moment. There've been some big announcements by the likes of Nscale, CoreWeave as the big publicly traded one continues. And so if their rollout plans, which again I stress, a lot of them, not all of them, but a lot of them are contract driven from end users. If that's anything to go by, then you'd say yes, it is bankable, and it's continuing to grow. And we've not even talked about enterprise demand for AI yet, which would then come on top of all of that.
Thanks, Andrew. And Andy, anything to add on there from your perspective?
Not really. I think Andrew's covered it quite well. I think from the coalface construction delivery side of it that I see, when you talk about bankable, I don't ever think I've delivered a project, a data center project that hasn't been required. I know, and we're seeing a lot more of it now from investors and from developers that we're delivering data centers on spec. They're speculatively investing. They don't have an end user quite as yet, but by the time we come to deploy it, there's definitely an end user and a requirement. It's quite different, I suppose, to pharmaceutical industry, where sometimes when you build a project, a drug doesn't get certification. That's not the case with data centers. The capacity is always required. So when somebody asks me about bankable, it's definitely a great investment. So it's something that definitely is required. And then now with the AI coming on board, I don't know whether it's just because everything AI is fancy and new, or it's definitely a higher level of investment and a higher appetite for that investment on the data center side.
I think you mentioned a few earnings calls, Andrew, and NVIDIA. I believe we're all waiting for 10 p.m. tonight to see NVIDIA's earnings, right? And just kind of keeping on the AI tone, we've had, there's been this big talk of a bubble. Sam Altman recently has come out using the feared B word, Meta. They've, I think, have stopped the AI hiring as well. So what one assumption about kind of that AI-driven demand you held a year ago do you think has changed, and why?
That's a really easy one for me, and it's inference. So a year ago, we said, look, this is going to be the year of inference, where we go from the large language models then actually to inference, whereby people are getting information out of these LLMs that they can use, and then that needs to be distributed to the end users, which is the essence of inference. I mean, dare I say, an edge type model, and that we just simply haven't seen yet. And Andy, I don't know if you've seen evidence of that being built out, but there's no question it's coming. But just to answer the question, it hasn't come in the last 12 months.
Yeah, I think the larger providers, the Metas, the Microsofts, the Googles, I think those guys they're always a step ahead, obviously, and they have the capital investment to do that. I think they're definitely going down the inference road quicker than we're seeing at the colo and enterprise level. But I agree with you. I suppose coming from that client delivery side to this contracting side. I suppose 12 months ago I would have thought that it would have been quicker, but I suppose with the large amounts of investment that are required to build these data centers, it's taking a little bit longer. But it is very interesting, and it's very interesting to see new investors and different types of investors getting involved in this space rather than the traditional investment model. So it's really quite an interesting space to be in.
Because I think you could argue that if you haven't got inference growing, then are people really using the AI? Because, of course, the inference is where people actually start consuming it. And I think that would be a fair point. But to your point about the Sam Altman comment, everything that we're seeing, Vlad, just points towards actual real demand. I mean, I can't overemphasize the speed to market issues that we're seeing with particularly the neo cloud companies, and it's those companies who are deploying the NVIDIA GPUs at scale. They are doing anything they can just to accelerate things by a few weeks. If you say, well, I can deliver a data center in 8-9 months, then they're not interested. It's got to be quick, and they're saying that not because they want to spend all the money, but because there's actual demand for their services. So that gives me enormous confidence that that there isn't, to use the B word, that bubble. And there'll be some some bumps in the road, but the underlying fundamentals, I think, are very, very strong. And let's face it, who's not talking about using AI and seeing the actual benefits, whether it's in biotech or autonomous vehicles or whatever it might be. Literally is no part of our daily lives now where you're not seeing some sort of AI application.
Yeah. Okay. Really interesting. Thanks, Andrew. And I suppose that changes. Progress perhaps hasn't been as fast as everyone had anticipated. And I suppose going on from that, what's maybe if we take technology aside, perhaps what has been kind of one of the, I suppose, the bottleneck to building out data centers? Maybe we'll come to you, Andy, on that. Is it kind of power, permitting, availability of kit, land, skills? I mean, what's stopping this build out?
I suppose it's probably a mixture of all of them. But the one for AI in particular, because we are seeing that the best language models are the larger models, and they take the most power. So obviously, and I think that's something that will probably change over time with the advance in technology that's going to have to come in the industry. But that's definitely something that, probably 12 months, 24 months ago, 200, 250, up to 500 megawatts was a huge data center. Now we're talking about gigawatts, which is, was unheard of a number of years ago. So with that larger scale comes stress on the whole supply chain, not only, transformers for power, the GPUs, chipsets, and even down to the racks. Everything, the whole supply chain is stretched at the moment. So I think it's a little bit of a perfect storm, but I think we will find a way. And I think, that's the best thing about the industry that we work in, that there is always advancements in the technology, and there probably will be a shift in a couple of years' time where we don't need all this power, we don't need all the hardware and technology, which may alleviate some of these roadblocks.
I'd just to stick on the supply chain question or issue, the current geopolitical environment with tariffs being sprayed pretty much anywhere you can see. How is that affecting data center development? Is it affecting it at all, or are we seeing a bit of slowdown with trade flows being disrupted somewhat?
At site level, we're not seeing it just yet, because a lot of the procurement has happened, 12, 24 months ago. A lot of the items that would be affected by these tariffs are long lead items. Andrew, you might see more coming, speaking to the clients at project conception stage, but at the moment at site level, we're not seeing it just the effect just yet.
Yeah, we're certainly seeing a huge amount of nervousness from the developer operator community, where they're being asked to lock into pricing with their end customers in advance when there's so much uncertainty around the tariffs. And I think there's a few lawyers have been rubbing their hands, looking at force majeure, and does a tariff, is that covered under force majeure? So I suppose the practical issue there is just any level of uncertainty just bogs things down, slows things down. So yeah, I think there is an impact. And I'm not seeing any immediate end to it yet.
Yeah. Okay. Really interesting. So this uncertainty going to need to be navigated. Picking markets going to be very important for you. And one issue that we've kind of touched upon is this issue of power, issue of grid constraints. Now, that seems, you read any kind of data center article or article on the topic, this is, there's got to be number two after AI is where do you procure this kind of power? And maybe kind of move on to our next question. If you are a data center investor and you had to pick a market by power availability, by electrons, kind of what variables are going to matter most to you? Is it kind of price reliability, low carbon power availability, access? What is it that you need to be concerned about when you're looking at a market?
I'm happy to kick that off. So for us, it's all about power price. I say all about, mostly about power price. And there's interdependencies. So the lowest cost power in Europe, broadly speaking, is in the Nordics. But the reason it's low cost is because a lot of it's through hydro, which is then renewable. So it's a fantastic set of circumstances. They've got a surplus because the industries that generation was built for way back when, those industries, particularly paper pulping and things, have now gone perversely because of people using electronic data more. And so that's where people seem to be going to build the large scale AI factories. But we have to look at the two different types of demand. There's the big AI factories that can cover a region, so America, Europe, Middle East, or Asia being regions. But then you've got sovereign regions. So as soon as you're into data protection issues, then you've got to be building in the country. So I think you've always got to look at the two. So certainly, to answer your question, from a location for pan-European locations, then it's Nordics because it's the cheapest power. It is also green. Second after that comes Iberia. So where the Nordics is running at the lowest, probably 3.5 euro cents a kilowatt hour, up to 4.5, 5 around that area. The Iberia area is about, you start at 8.5 euro cents up to 9.5. So it sounds like a lot, but that's still very low cost compared to the traditional old markets of the Germanys and the UKs.
I think when it comes to delivery of these projects, I think a lot of the questions that we ask at very early stages is, do you have a commitment from the local authorities? What is the appetite of the local authorities where we're going? Does the development fit with the development plan of the local area? And then once we have those sort of questions answered, then it's when can we get the minimum amount of power required for temporary power, for commissioning, etc. Because you don't need all the power straight away, which is a common misconception. A lot of people think the minute you get your permit that you're going to need all of your power, but it takes time to build. So that's they're the early questions, and then when we do get into turning up and provisioning the data center, it's around the quality of that power, and obviously then if it's a higher quality and it's backed and we know that there's not going to be any disruptions to that, then we can start looking at more sustainable sort of reducing generators and not having to have that after meter offsite power generation, but there's still a requirement at the client end to ensure that they know they're always going to have their power.
Maybe kind of parking the power bit, something you said on around permitting. I suppose when we're thinking of strong projects, all the fundamentals lined up to be able to deliver in that kind of consent permitting stage, what are some of the biggest risks within that stage, and how could you work to, I suppose, mitigate some of them? Maybe Andy, will throw on that one to you.
Yeah, the ones that I've come across in the past are going to develop a project but not having the full permit for the full power that's required, only having early engagement with the local authorities that isn't a definite that you're going to actually get the full power requirement for the project. That can delay projects and that can cause issues. Then having that open communication for the guys to understand at government level when you're actually going to be deploying and when it's going to be fully required. That's key, and having those good relationships. But other than that, it's about that clarity, and again, going back to the appetite of the area and the local authorities and AHJs, that it fits in with the development plan, and it's not taken away from other developments that are in the wider area, and you're not a bad fit for the overall location.
We've got some sort of perverse situations there as well, with that dynamic between planning permission and power procurement. So the power companies are saying, look, unless you can demonstrate you've got a viable scheme, we're not going to give you the power connection offer. And they define viable scheme as a scheme having planning permission, for example. So it's a heck of a commitment to secure land, obtain a planning permission, if you then have to run the power permitting process separately from that and in series rather than in parallel. And so there's a lot of working out of these issues that's still to be done.
And I feel that we've talked about the risk quite a fair bit. I suppose what are some of the opportunities? I think, Andrew, you and I had spoken previously about SMRs being used, data centers, some of the behind the meter solutions. So when you're actually deploying capital, which parts of the power procurement, I suppose, process are in your control, and how can you kind of generate value with those?
Yeah, the alternative power sources are traditionally, and indeed, if you look at Ireland at the moment, virtually all the new data centres are gas. They're generating their own on-site power through gas-fired engines. SMR, absolutely, nuclear SMRs are on the way. And just look at what's happening in the US, the big names that are committing to SMRs, then it's happening. But from a European perspective, we generally speaking have a higher level of regulation, and so it's going to take, I think, you're not going to see a new SMR, say, in the UK for another 9 years from today, 8 or 9 years, something like that. And so the problem with that is that the capital wants a return straight away. They're IRR driven, and so anything where you say, it'll be fine in 8 or 9 years time, you get laughed out of the room. And so there is this imbalance between the time it takes to deploy things like SMRs and the capital requirements. But the other issue that I will keep coming back to is the requirement from the end users, because for me it's all about the end users. Their time requirements. They don't know what on earth is going to be happening in 8 or 9 years' time. They just know what's going to happen in the next 12 and 24 months' time. And so the capital is coalescing around those groups that have a viable scheme that can be delivered relatively quickly in a couple of years. And it's becoming very, very difficult to attract capital for much longer term schemes, just for obvious reasons, particularly around the IRRs.
Definitely, I think you've touched on everything that I think everybody in the industry is looking at. I think because I suppose it's dominated by engineers, we try and find a solution to the problems. I think it's probably incumbent on us as an industry to be more efficient with the power that we have. I think that's probably the next stage that we need to get to. As Andrew said, there's a lot of gas generation. There's a lot of off-site generation, offsetting with PPAs, etc. Well, that's the thing. They're the things that we know. I think we need to do better as an industry, and I think we need to find ways to use these large amounts of power more efficiently. Whether that's then changing in the hardware or the chips that go into it, that they are more efficient to actually do the process that we want to do. So we don't have to go and take gigawatts off the grid. But again, that's not my field of expertise. But I would put some positive tension on it that we do start thinking about it. And I know from people in industry, from friends and previous colleagues, that's definitely what's being looked at.
And I think there's evidence of that. I mean, for me, the renewable piece is all about additionality, and we're seeing, rather than on a micro site-by-site level, we're seeing the big global cloud companies investing billions of dollars in brand new renewable energy projects. It's fabulous. I mean, it's really good what they're doing, but we've just got to remember that that's at a very, very high level. They're investing in the actual offshore wind farms and things, and that's how they're choosing to do it, rather than necessarily have on-site renewables, albeit people are looking at that as well.
Yeah, and I think you're touching on a really interesting point there about low carbon power solutions to these data centers, right? And I suppose the license getting onto sustainability on the SMRs. I had a look the other day on who actually has operational SMRs across the world, and people might not be surprised about who it is, but I think it's China and Russia are the only two with operational SMRs. And then China and Russia again have them in development, and Argentina too. So if you're a data center developer looking for low carbon sources of power, Argentina is your big bet.
But it's funny. I had a conversation with Rolls-Royce recently about the SMRs, and I said, and I, very naively, I said, well, is it all safe, and have you got experience? And they said, Andrew, we've been running nuclear submarines for 20 odd years. That's an SMR. That's all that we're talking about here. And so I was really put back in my place and said, okay, I get it.
Okay, good. Glad Rolls-Royce are thinking about these things. So yeah, just back onto the, I suppose, net zero aspect. What does a credible net zero path look like for data centers? Is it that availability of clean power, demand flexibility, reuse of heat? I suppose what's actually realistic? And Andy, maybe you're a bit closer to this. What are your thoughts?
Again, all those things in the perfect mix, but also then having the correct selection of construction, the correct materials. Under it's not it goes back to the very beginning of the inception and design that you build these targets in. So from the very beginning that we're looking at different ways of delivering the product in a more sustainable way. But definitely, everybody has had this on their radar, 2030 being their target. I don't think there's any provider out there that's not looking at it. And I think it's brilliant from our point of view that it's right the way through the value chain. It's it's investors, it's operators, it's end users, it's everyone is on the same page that they want to get to these targets. So it makes our life a lot easier than when we were coming with alternative methods of construction or alternative product selection, etc. So it's not something that's not achievable, but it's definitely on everybody's roadmap.
And what measures are developers taking now, Andy? I think I read about a project a year or so ago in Hammersmith where a data center is going to be hooked up to a district heating system near a school. I mean, what's going on now that is either being tested, piloted to kind of come up with those sustainable solutions that can be used in the future?
Yeah, district heating systems have been around for a while. Again, if it fits, if the location fits with your facility, Meta have a project in Denmark that's tied into a large district heating system that, as far as I know, does a large portion of the town. And there's Amazon did one in Dublin as well, on a smaller scale. Unfortunately, not everywhere has a large district heating system that they can tap into. But I suppose that's just one that for a long time we've been looking at how to harness that waste heat and how to reuse it. But now even to a different level where we have for the last for a number of years, 4 or 5 years, where when projects come across the table and they're at design stage, we're looking at very different forms of construction. Going away from concrete, going away from steel, going to timber. Really, absolutely everything is on the table. If there is a sustainable justification for it, it's not solely down to price point anymore. It is there a more sustainable option? And everybody understands that we need to reach those targets. So, as I say, it's a collective approach.
We touched on those demand drivers. I think the other side of demand seems to be stemming from the allocators. We had 45% of all fundraising this year went to data centers. And so the likelihood we're going to see a lot more investment in data centers because that's what the LPs, the pension funds want and need, right? So in an active market, in a congested market, says Andrew, maybe to you, how can you differentiate yourself, generate value, continue to generate those returns for your shareholders? And the age-old question is there anything left for anyone in the sector anymore since it's moving so quickly? I suppose, how much opportunity is out there and how do you capitalize on it?
There's still lots and lots and lots of opportunities. And I view it as being just totally linked to the demand. And we've talked about demand going up. So my advice to the investors is you've got to spend a lot of time just understanding what a data center is, what the demand drivers are. And the demand drivers are totally split from cloud to AI. It's not simple. Is it real estate? Is it infra? There's a lot of things you've really got to understand. And it's not like investing in an office building. You can go into any city in the world, walk around the CBD and get a pretty good feel for whether an office investment is going to be any good or not. Look at the footfall. Data centers aren't like that. And we are seeing people adopt, in some cases, the wrong strategies because they don't understand where the demand is going to be, just even geographically where it's going to be. And some people are getting it wrong. Those that are in it and have a portfolio, say, of companies, they are starting to live and breathe it and are making some extremely good investments. And I think we'll end up with the knowledgeable people deploying a lot of capital, making a lot of money, and then there will be a lot of people who just can't access it. And also the lot sizes are just getting so ginormous that I think that's becoming a barrier as well, albeit there's a lot more club type deals which would provide access as well.
Very, very interesting. And I suppose something that investors have to be conscious of, and we've seen this impact renewable sector, is the shift in the cost of capital over the past 5 years. Now, with many stories about Ørsted coming out in the news over the past couple of weeks, is the cost of capital a big issue for investors when developing data centers, Andrew?
I don't think it's a really, really broad brush statement, but no, I don't think the cost of capital is the issue. It's the availability of capital for these big schemes. And of course, there's a link between the two things. But broadly speaking, and I've asked this question of some of the big developers. I said, goodness me, should I be worried that you're not going to be able to get enough capital? And the answer generally is, look, there's more capital chasing these opportunities than we've got opportunities, so we're absolutely fine at the moment. But I think there will be some bumps in the road. So we had a couple of the big cloud companies announced pullbacks, so-called 6-9 months ago, and the really knowledgeable investors were pretty fine with that, because they got it, they understood what the pipeline was looking like, and they understood the reasons. But a number of the new investors were quite spooked by that. And so again, it goes back to that point about those that are really knowledgeable, I think, will be fine and they'll make the right decisions. But there's a danger for those that are just kind of following the herd and making some less well-informed decisions.
I think we're a couple of years away from understanding, what that financial model is especially around the new AI data centers, because the return on investment is quite different to a standard compute data center that we would be traditionally, au fait with. And I think until we know exactly what that is, I think that there will be some, well, not misinvestments, because as I said at the top of the discussion, I don't think any data center will turn away. capacity, and somebody will take it somewhere. But I don't know if it's going to be, if every one of them is going to land for what the intended purpose. And that I think we're going to start seeing that as well. That some of the projects that are being built, and as Andrew says, maybe in the wrong locations or maybe for the wrong end user, they may have to be repurposed, and and that's something that may have to happen.
I mean, the other point, Andy, on that, of course, is the covenant strength, the credit of the neo cloud companies is very, very different to the biggest companies in the world, the hyperscale companies. And so how you fund the AI growth, where they're moving from taking a few tens of megawatts in an existing facility where you've already spent the capital, to coming out to the market to say, right, I'd like you please to build a brand new facility dedicated to me, and it's going to cost you $2 billion. That then automatically comes back to the funding. And this is where I suppose I made the point earlier about the key is understanding exactly what the AI neo cloud companies are doing. So some of them, for example, will have a customer underpinning the entire deployment for them, and that customer could be one of the global cloud companies. And if you can tie them into the deal potentially, then suddenly the financing issues become a lot easier. And so it's things like that which I think we'll see develop. But an unknown neo cloud company who's doing something speculatively is going to find it pretty damn difficult to raise the hundreds of millions, billions required.
That availability of capital point that you made earlier, Andrew, I mean, forgive me if I kind of ask about what other types of capital are available. There's 60 billion already been allocated this year, tens of billions more last year. I mean, where else is the capital coming from? Where else do we want it to come from?
Yeah, I think we're seeing it split up into the typical parts of the stack. Really, we've got the PE side, which remains very strong. With the scale of some of these, we're now seeing people like the sovereign wealth funds, quite a few of the Far Eastern and Middle Eastern sovereign wealth funds come in. We've got the traditional infra funds that have actually been in the market for quite a while. And then we've got what I view as very, very traditional institutional, pension fund type money that's coming in also. So all of those groups I've just mentioned have quite different returns on capital employed requirements, risk return requirements. But because we're developing such big facilities, and there's such a variety from the spec build to the pre-let to the pre-let from a hyperscale company, very good credit. There seems to be a place for everybody, and the capital stack is varying to reflect those changes, almost on an opportunity by opportunity basis. But you look at Mark Gamzee and some of his comments, Digital Bridge, he's spending, I don't know what percentage of his time running around the world sourcing capital and doing it very, very successfully.
So it's really interesting with new investors coming into the market, and as I said, I think it's more because of they want to be involved in some sort of AI, but yeah, the new type of investor that's coming to the market is definitely more involved. And I think I said to you before, it's because of the large amounts of the capital that they have to deploy. So they're not sitting in their office and looking for regular updates. They're on site. I've had a couple of them already sitting beside me, looking to see exactly where their money is being spent. So it's definitely a new time for us in the data center delivery market.
So you mentioned a few of the pitfalls, particularly for new investors that they could see within this market. So what would be your kind of two moves that investors should take to kind of position themselves to make sure that they're on the right side of this cycle, I suppose, this year and the next? Maybe we'll go to you, Andy. What do you think?
Selfishly, I suppose if you're new to this and you're new to this investment market, I'd say reach out to ourselves and CBRE and Andrew in his advisory capacity. Get to understand the market before walk before you can run. As we've both outlined, it's not the same as investing in any other market. There are pitfalls, and there are great wins, because, and as we said, we don't know what the potential of those wins. The sky's the limit with AI at the moment. So yeah, no, definitely do your homework, as every investor would, but probably get closer to the people that are in the market for a long time, and have that tribal knowledge. And we're very welcome to we welcome the discussion.
And I think from my side, you've sort of stolen some of my thunder, I think, Andy, in terms of. So I was going to say the two things. Number one, very, very specific, is understand what the AI companies, the neo cloud companies, are actually doing, and the point being what's speculative, what's contract led, where it's contract led, who's the contract with, and often that's not very obvious, and you've got to delve. You're delving under the covers to understand that. But I think that's absolutely key, and then make some decisions, because the neo cloud companies are not just all the same. They actually have some very, very different flavors of what they do, the services they provide, and the types of end customers that they serve, and who underwrites them. And so really getting under the skin of that, I think, would be the first thing. And then the second thing is, and I touched on it earlier, it's understanding the demand side in terms of locationally. Where are these locations where people want to go massive gigawatt type factories versus near site, near to the availability zones, and then in some cases on top of the availability zones? And if you look at those three different types, so far sites, near sites, availability zone sites, they all look very, very different, have very different risk profiles, but really understanding those three, I think, is the other key part of the success.
You mentioned location, very important. Andrew, you also talked about Iberia and Nordics as being attractive markets. If I had to kind of put you on the spot, what market are you looking out for this year? What's the one to watch, and perhaps what's the one to give a rest for a couple of years?
Do you know, the really interesting one for me is the Middle East. I appreciate that's a region, and I'd choose KSA, Saudi, if I had to choose one, because the plans there, and the amount of capital that is being deployed there is eye-watering. I mean, it's just extraordinary. And the Middle East, including Abu Dhabi, obviously has got the Stargate stuff going on, which again, is a gigawatt to start with, could ramp up to 4 gigawatts. I mean, oh my goodness. I mean, it's ridiculous. I mean, fantastic. It's off the charts. So I think that region is really coming up very quickly, and I personally am going to spend some time there over the next 12 months, because I think there's some really good opportunities. And in terms of where to kind of watch out, we have got this syndrome at the moment where people have got some power wherever it might be, and some land. They think it's going to be a great place to build a data center. And a lot of people are just simply wrong. That's just not the case. So if you've got land and you've got power, look at it, think about it for data center, absolutely, but don't think it's a no-brainer, because 90% of those sites actually won't work, but there'll be a magical 10% which are phenomenal investments, but you've got to get it right.
I think you mentioned earlier on, and we've spoken about it a couple of times, I think, definitely on the delivery side, and the projects that are impending, we're focusing quite heavily on the Nordics, and I think there's a lot of investment, as we know, and for various reasons, for all the right reasons. But I think the secondary market, as Andrew spoke about, in the Middle East, but I know are having a lot of discussions from people from North Africa and the African market. While obviously there are larger hurdles to jump there around, whether it be geopolitical or whether it be the grid infrastructure, etc., and access to power. But I think that the appetite from the people in the locations, the appetite is definitely there. They want it, and they're going to find a way. And we, I think that's one thing that's brilliant about this industry, is that we will always find a way to deliver, in the most obscure and remote locations. There's nothing that we can't get a solution for. So it's a very, very interesting question.
Great. Well, thank you very much, both. I think that brings us to the end of our podcast. Certainly appreciate your insight. I think we've covered a lot of ground here. If by this point you're a listener, you don't know where to invest in, what are the demand drivers, I think you've probably not been listening very, very hard on this podcast. But I'd like to say, big thank you to you both. Really interesting.
Thank you very much indeed. No, it's been a pleasure.
Thank you very much. Yeah, it's been great.
Thank you for joining us on Talking Global Infrastructure. You can find out much more about our latest insights and reports on our website at GIIA.net. That's GIIA.net. You can follow us too on LinkedIn for the latest interesting news. Please do join our mailing list for monthly bulletins about what we're doing, our events that our members are always welcome to join. I really hope you've enjoyed this episode. Do follow us on Spotify, Apple Podcasts, and YouTube. You can watch this all in its glorious detail. And finally, if you've got an idea for a podcast, or would like to partner with us on a podcast, please simply email at communications@giia.net. And we look forward to speaking to you next time.